Now, the global cross-border payment industry, valued at over $65 trillion, is undergoing a seismic transformation as digital innovation, blockchain adoption, and stablecoins redefine how money moves across borders. With Africa's growing intercontinental trade and fintech ecosystem, the continent stands to benefit immensely from faster, cheaper, and more transparent payment systems. But what trends are driving this change? And how can stablecoins and digital rails facilitate seamless Pan-African trade? Today, Ifelade Ayodele, CEO and co-founder Blaaiz, joins us now to discuss this further. I want to say, well, Ife, good morning to you.
Good morning. It's a pleasure being here.
All right, let's start it off by finding out from you. The global cross-border payment market, according to statistics, says is over $65 trillion. What's fueling this rapid growth and transformation?
I think that apart from the fundamentals such as urbanization, population growth, I think it's also things around the global workforce. It's becoming more and more, should I say, fragmented and dispersed. So you see people who would typically not have certain jobs now begin to own that, and from the comfort of wherever they are at. So it is that workforce globalization that's driving the growth. And in terms of the transformation, it's things like expectations. People now demand higher availability. People demand speed, and all of that. It means that digital rails need to be in the play at some point. And of course, lastly, it's things around stable coins that makes the whole process happen faster and seamlessly.
Now, my own question, before we, permit me to just probably chime in here. Some people claim there is a bubble in the fintech space because things are just springing up, reminding me of the whole 99 bubble with the dot-com bubble and the rest of them. Is that true? Or do you think that there's just a paradigm shift?
I think it's a paradigm shift as opposed to being a bubble. And it's again, like I said before, it's times are changing, expectations are evolving, and also demography of the world is changing. So it's like what has served the millennials, if I would put that, doesn't now serve the Gen Zs. And so as these behavioral patterns change, you also change in our expectations of services that we need to thrive and survive, which payments is at the core of that for every industry and every service.
All right, so let's come down to Africa. How significant is Africa's share of global cross-border payment flow? And what are the opportunities that lie ahead? Okay, go on, start off with that.
Yeah, I think in terms of the share, it's still single digits relative to what we see in other continents and flows that happen. But again, on the back of that, it's also the fact that it's the fastest growing. And like I said before, it's because there's a young demography of people who are now forced into the economy where they may not be jobs in their respective markets of, should I say, residence, but they're now able to work and export their talent. So whilst now it is still, like I said, still quite low, but the potential, and then it's also data back to that, it's one of the fastest growing in terms of what we see, and also for SME flows where now the economies are rising up to the fact that they need to export more, and then also that means that money has to change hands or move across borders. So it's the opportunities are there, and then hopefully in the near future we can see us taking some sort of double-digit number in terms of share.
I'm a big skeptic because I believe cross-border payments in Africa is extremely poor and very expensive. What do you have to say to that? Because infrastructurally, you look at what is happening in countries, Kenya, Nigeria, Ghana, within those vicinities, payments are way better than when you begin to do cross-border payments. And I look and say, why? Why is it that expensive? And yet you don't get value for money.
I think it's the very setup of how Africa is as a continent. Our regulatory regime is quite fragmented. So that's like the base of everything. So it means that whatever you would attain as, or you recognize as KYC, because at the end of the day, when money needs to move, we need to know who's moving it and where it's going to and what for what purpose. So what a Nigerian bank or regulator would see as okay or sufficient to initiate a trade would be different from what a Ghanaian regulator sees as sufficient to accept that trade or even recognize it. So that's fragmentation in the KYC or the regulatory landscape increases.
Well, how difficult is it to just standardize some of these things? and use probably international models like maybe Stripe or whichever actually comes as a base model to say this is at least this is the barest minimum of KYC you should get to be able to make it into our platform and trade with our platform.
Yeah, as much as that sounds like quite easy to attain, it's not very easy because remember you're dealing with at least 54 African countries, different countries at different stage of, should I say, development, and also different appetites for risk. So it's a whole bucket of issues that you could begin to unravel. But again, we're seeing things that the regulators are working on. For instance, the PAPs, the African Continental Free Trade Agreements, wherein they're now seeing some sort of convergence as to what is expected across for borders, cross-border transactions to happen. We're also seeing at the global scale the ISO 20022, wherein there's almost a sort of standard messaging for transactions to go through, so that when a transaction originates from a particular country, going into the next country, whatever they might need or need to process that transaction has already been fulfilled, and then there are no discrepancies as to things that are, oh, we need to send this money back, it doesn't fulfill our requirements, and all of those things. And also, of course, like I said, with stablecoins are also beginning to help to facilitate that. So you begin to see things like atomic P2P, wherein payments and settlements, as you call it, would happen simultaneously, and that's only possible when these things are taken on-chain, as we like to describe it.
All right. So how does money laundering slow down some of this platforms we're talking about? Because I know it's a huge problem, and it's something that no one wants to get into, but it's a reality that is happening on a day-to-day basis. Because when you look at the amount that the international community actually put out that is being laundered every year, so I mean it's over 200 billion, and we say these things. How is it affecting the regular people that want to just do trade without having to bother about any of this?
So, of course, with every field or endeavor, there will always be people who are out to for the wrong reasons. No matter how airtight you try to make the processes and the regimes that kind of like control the space. So, in terms of money laundering, that is a thing, right? But it's also not unsurmountable. So, regulators need to work better together, which is what I said before in terms of standardization of expectations. And then it also needs to be that we need to grow together as a whole. So in African markets, there are quite some markets who have been perceived as more mature in how the regulatory regimes handles AML and stuff like that. So it is how we make sure that the advanced markets are able to bring up the other ones, which is also, as a standardization. It doesn't have to be things as we have in Europe, where there's something called passporting. If you're licensed in a country, you can do stuff in other countries without no hassle. It's also things around recognition. We've seen that already in things like Ghana, Rwanda, and Africa, for instance. There's some of conversations around recognizing licenses and making sure that what works here, what works here, opt-ins here. It is when people see that there are gaps and vulnerabilities within systems that they have to interact with. That's the very fundamental exploratory phase for things like AML. So it's us coming together and also ensuring that there's full transparency. Of course, some of the things that stablecoins brings to the table, it's also ensuring that they are on-chain audits and trails and all of that. So it's going to be an ongoing battle. I'm not sure that there will ever be a point where these things cease to exist. It's how more proactive we can be to ensure that as they happen, they are caught, and then, of course, there are consequence management.
All right, let's move away from negatives. We were talking a lot about negatives. Let's talk about the positives and what platforms like yours actually bring to the table. Talk to us about how are they helping reducing transaction costs and settlement delays.
So there are the ways we do it in terms of like how we help the whole process to be seamless. Either it is in terms of convenience for the users, in terms of speed, in terms of transparency, in terms of still making sure that trust in the system is preserved. So first is we ensure that, of course, as we onboard people or as we trade business, we ensure that the whole process of onboarding and getting data is foolproof. So it's not enough for you to give us stuff. So there are business registers, there are databases that, as opposed to traditional institutions that we do have to commission some sort of very physical infrastructure, digging, and all of that. All of this can happen in seconds to ensure that first we are working with the right people and their intentions can be trusted, at least at the point where they come in. And then apart from that, secondly is also ensuring that transactions are adapted to suit local needs. So and another way to describe that is to say that there's no reason why a small business in Kenya has to take money from in a bank when they can get their money from a mobile money account. So it's making sure that these things were connected to as many local rails that as much as possible for convenience and ease of use of the users. So those are the ways in which we ensure that transactions happen faster and seamlessly.
All right, fantastic. Now, while we've been having the discussion in the last 10 minutes, you've been mentioning, you've been dropping stablecoin. Now, please, for those that do not understand, okay, just enlighten us a little bit. What's stablecoin? Because we know it's growing rapidly across the world, and certainly it's looking like the next big thing. So talk to us about stablecoin and its influence and the impact right now.
In simple terms, they're just digital currencies. So think of it as the way we emerged from cash, people having to do cash to where it's now e-money. So now it's still e-money, but it's now a digital currency. And one key advantage of a digital currency and stablecoins, as I put it, over the natural systems that we know, is that it makes things faster and easier. So now central banks, as we have seen, have started to issue their own digital currencies. So what that means is that when there is need for money to transform within currencies or patterns or forms, it makes things easier and faster. So if you wanted to do from dollar to euro before, you probably need to find somebody hours. Stablecoins ensures that that can happen in seconds. So it just makes things more fluid, liquidity is preserved, and then everybody can transact at their own pace and will.
All right, so what role do central bank digital currencies play in improving cross-border transactions efficiently? And talk to us about the oversight.
I think number one is that one of the things that we see in cross-border transactions is that there's usually a hassle of reconciliation and settlement. So central bank digital currencies, number one, they ensure that these things are catered to in terms of origination and settlement. So there's something called atomic P2P. Yeah. So wherein transactions happen now and then they settled now, as opposed to if we were to use the usual Nostro on-chains where it goes from a bank in New York on Monday, it's getting to Nigeria on Wednesday. That's when they're finding out that, oh, there's a mismatch somewhere. You need to go back, and that's like taking 1 week already. But digital currencies ensure that both legs of these transactions are happening immediately, and then you can cancel out wasted hours or efforts that would have been expended towards ensuring that things are happening. And also, it also gives room for audits and trust in the ecosystem, because, of course, introduced by the central bank, so you can trust that this is something that they would have thought through end to end. So that's how they have been ensuring that this adoption grows and the people are more comfortable to use it.
But why is this not seen as priority? Because I look at Africa, and the truth is this: everyone says Africa is the new frontier. We've got the market, we've got the people, we've got the appetite, but it seems like we in Africa are not paying keen attention on the changing climes, the transition, the evolution, the metamorphosis. Because I look at this Africa Continental Free Trade Area. We're hoping that by now, if that is in place, regulatory frameworks should be standardized across. Do you ever think that we'd ever get to that particular point whereby great initiatives, groundbreaking initiatives like this will come to fruition and help trade and also help cross-border payments?
I think it would, and then the African...
But if it would, when? Is the big question.
So the when would have to come. It's a function of other things being in place, and I'll give you a few examples of that. I think, like I said in the beginning, identity portability is the baseline. So if I give you my ID card as a Ghanaian in Nigeria, there has to be a way you can reconcile and be assured that this is fine and it checks out. That's number one in terms of what are the things that will take us to that point. Although, like I said, the groundwork is already being covered. And then secondly, it's trying to ensure that even as we had difference in our, should I say, local nuances and specifics as a continent, we want to ensure that there are new ways to digitize things. So for trade, for instance, there has to be a way to get that customs papers are in electronic copies, you put in trade credits, and all is happening on one platform, which I would dare say that the PAPS platform serves as a good fundamental, should I say, start point for. So it will get to that point, but it also means that all the infrastructure, should I say, layers have to come in play. ID has to come in play, trade credit has to come in play. All of those things have to be in place to ensure that every need as it were, can be met on one platform, and then the countries are in sync.
All right, let's talk about stablecoin, blockchain, and how this helps. Because we spoke about money laundering, which is a huge issue globally. Do you think stablecoin and blockchain actually helps enhance transparency and trust in this cross-border trade? Because it's a big issue.
Yes, it does help with the right guardrails. It does help. And these are, I mean, I think two major ones will be that it does help, but there has to be some sort of regulation and proactive involvement by the relevant parties, governments and regulators. It does help, and it does help in that things on the chain, as you call the blockchain, are quite transparent. There are audit trails. You can see who is starting what and who's ending what. So those things help to give that assurance that the chain is safe, so to speak. So it does help. It's just a thing of making sure that every hand is on deck and there's enough education and proactive, should I say, enlightenment on the part of the regulators, because needless to say, people that are not regulators seem to have a better grasp of what's happening in that space than some of or most of the regulators. So it's not just needs to be a thing of where regulators need to level up and also ensure that they are working collaboratively with.
The question is why that's so, because I look at Nigeria, for example. Let's use Nigeria as a case study, and I think and I look and I say to myself, why is it that banks, for example, use them as case studies? I do not know of any bank that is a top fintech provider, and that is because they have the money, they have the reach, they have the customer base already. Do we need to take the bull by its horn? Because why is it that the regulators are so far behind the curve when it comes to these kinds of instruments, platforms? And fintech should be evolutionary. And the people that have operated fiat systems over the years should be forward thinking. But they seem that they are lost. They are living in their own bubble. While some of us are thinking of the new frontier.
It's three things majorly in my own assessment. First is that the current way of doing things still serves the banks. Whether you choose to admit it or not, banks still make a lot of money from interest incomes, from transaction fees, all of those things. And as humans, at the end of the day, everybody needs some sort of sanction to get better or some sort of threat. So now it's already a threat, but it's not as massive at the point which it begins to be very concerning. And some of the more proactive ones are actually taking the bull by the horn and going on. And then secondly, on the
regulation... But it's still very slow. The reason why I say this, there's something called the blockbuster phenomenon, if you understand it, with how video sharing was done back in the day. Then Netflix comes with a new model and they tweak it. And before you could say Jack Robinson, one particular industry literally dies and another just springs up, and it's been up and up since then. Some of these people, don't they look at this and say that maybe are we not leaving money on the table? And is the world not leaving us behind? Because I look at it and I say it's almost like a no-brainer. Apps like yours and a million that we can actually mention are pushing the boundaries, pushing the antennas, and they're getting results. And the unbankable are becoming bankable because they've actually lowered the bar of entry and the rest of them. Is it good for you, or do you think that there will come a time that some of these financial institutions will wake up and smell the coffee?
It's two ways. It's good for us to some extent.
Okay.
As of now, it's good for us in that to the extent that they are slow to capture some of these opportunities. Early adopters, that is users and individuals who are, should I say, not so risk averse, would come to us and then find the use cases, and they would ultimately be able to transact. But again, for us to scale, it has to be a partnership. Banks cannot be exempted, especially when it comes to trade. It has to be some sort of collaboration between fintechs and banks. And banks in this instance, most times they don't need to take the front position. They just need to support us with the trust that they have earned over the years with people, with regulators, and then we can have a very symbiotic relationship. So I'll give you an example. At the very early stage of a typical fintech, what you're selling is convenience. The UI has to be smooth. And at that point, banks can sponsor fintechs. in terms of all of the back end operations and all of that. But as a fintech starts to scale, what the fintech starts to do is like they need a consortium of banks for smart routing to make sure that transactions are happening and they're able to connect to local rails. At that point, banks go from being just sponsor banks in terms of just putting your stamp on the fintech to say, how can we provide liquidity pools for you across your jurisdictions and all of that. And then ultimately at scale, it's banks coming into core markets to SMEs. So, but again, fintechs need to be at the forefront of this, making sure that, because fintechs are better at solving, should I say, direct customer facing problems, and banks can provide the trust.
No, but banks are in the business of solving direct customer problems, but they seem to have dropped the ball on that.
I guess times have changed.
I'm hoping that, I don't know, I don't think so. I'm hoping times have changed, but I don't think so, because you can still go to banks and they'll still tell you that it will take 10 working days to have your problem solved. And fintechs do it like that.
But again, that's, like I said, it's mostly the case for most early adopters, people that have serious money. I would say serious money in this context.
Yes.
To do, they still would appreciate a stamp of approval from a bank to be able to freely transact with you. But again, the trends are shifting. People are no longer doing high value, low frequency transactions. There's not high velocity. It is low value, high frequency. So it's only a matter of time between people would not in code care much about a banking approval, again, as much as they would about convenience and being able to do the transaction seamlessly.
All right. Ife, I want to say thank you very much for joining us today here on Business Week. We were speaking to Ife Lade, your daily CEO and co-founder of Blaaiz.